Hello, this is Ahmad Quqa, and welcome to Crescent Private Wealth's April 2026 market update. Today, we'll be looking at the following topics. We'll begin with a discussion about economic news in the US, followed by a discussion on interest rates and the Federal Reserve. We'll look at US stocks, then we'll look at non-US stocks. And finally, we'll end up with some commentary on the war in Iran and the situation at the Strait of Hormuz. So with respect to economic news, in the month of March, the US economy added 178,000 jobs. This was much better than market expectations of a 59,000 gain. Also, the unemployment rate dropped to 4.3%. And in terms of economic growth, first quarter 2026 GDP came in at up 2% annualized, a strong rebound from the 0.5% annualized Q4 last year. But in the same release, the Fed's preferred inflation measure, PCE, surged to 4.5%. Now that's a meaningful jump to note, but on inflation, the March report showed inflation jumped to 3.3% for the year, up from 2.4% in February, and almost all of that came from gasoline, which saw a surge of 21.2% in a single month. So we're seeing here is that the job market is still strong, growth is rebounding, but inflation is moving sharply in the wrong direction. Let's look at this chart of US quarterly GDP growth, going back to the end of 2024. What I want to highlight here is the bar on the far right, the first quarter of 2026, which came in at 2%. You can see a few interesting things in this chart. The first quarter of 2025 actually contracted slightly. Then the second and third quarters of 2025 were unusually strong at 3.8% and 4.4%. Then the fourth quarter of 2025 dropped sharply to just 0.5%. That reflected the government shutdown and the softening at the end of last year. Now, the reason Q1's 2% number matters is timing. The war in Iran began on February 28th. So out of the 3 months in the first quarter of 2026, only 1 month had any meaningful war impact embedded in it. So the full effect of $4 gasoline and the energy supply shock will show up in the second quarter, not this one. So while today's number is genuinely a positive surprise, the real test for the economy will come in Q2. This is the US national average retail price for a gallon of regular gasoline over the past 18 months. As we can see, for most of 2025, gas prices actually had been coming down from around $3.07 last November down to $2.73 in mid-January. The cheapest gas had been in years. Then the war begins on February 28th. You can see the line just shoots up past $3, past $4, and now the national average is at $4.45. That's a massive hit for households, for transportation, for commuters. And it's why the new revised full-year inflation forecast is up to 4.2%, more than a full percentage point higher than what it was before the war. This is from the Bureau of Economic, BEA, and it shows 3 measures of inflation over the last 6 quarters. For most of 2025, all 3 of these inflation measures were roughly between 2.5% and 3%. They were elevated, but they were stable. Then in the first quarter of 2026, you see this sharp upward break, and it's why the Feds are in such a difficult position right now. The economy is still expanding, but inflation is now well above where it was just 3 months ago. So with respect to interest rates, in terms of rate expectations, before the war, markets had expected 2 Fed rate cuts in 2026. With inflation now this high, we might be looking at best 1 cut, but also an actual rate hike might happen. Lastly, in terms of Fed leadership, Kevin Warsh advanced from the Senate Banking Committee, and full Senate confirmation is expected the week of May 11. Now, Warsh is known as hawkish and inflation-focused, so market expectations will likely shift once he is in place. Another way to see how the market is responding is to look at the yield on the 10-year US government bond. For much of last year, the 10-year yield was trending lower, and by late February, it had slipped below 4%. And then once the war in Iran began, it went from below 4% to nearly 4.5% in just a few weeks. As of April 30, it's at 4.4%. That's a signal that markets are expecting higher inflation. And higher long-term yields affect mortgages, car loans, and many parts of the economy. Now let's talk about US stocks. From the start of the war through mid-March, US stocks slid roughly 9%. But then, stocks came back to push to all-time highs. The S&P 500 marked its best month in April since 2020. So far this year, the broader market is up, and small caps have been the standout. Majority is coming from communication services, information technology, and consumer discretionary. So here's how to think about it. Markets are essentially assuming that the war will be resolved. The risk is that their early re-escalation or a permanent Strait closure are still the big downside scenarios. This is the S&P 500 index going back to 2024. The pink line is the 200-day moving average. You can see how when the war began, the index fell sharply. That's the roughly 9% drawdown. And then we see this powerful recovery. The market has fully recovered from the war-related losses and then some. This chart shows the performance of 5 key sectors in the S&P 500. For the year, energy is still the leader, up about 25%. But, and this is what's interesting, energy actually pulled back about 9% in the month of April. And the reason for that is, when the ceasefire was announced on April 8th, markets started pricing in the possibility that the Strait of Hormuz would reopen and oil prices would come back down. So energy stocks, which had been the biggest winner, had the biggest April pullback. You also saw high beta growth in April. Communication services and tech both up around 13%, and consumer discretionary up more than 10%. Meanwhile, financials were left behind, with their worst first quarter since the 2023 banking crisis. So the sum total here is that the US equity recovery has been broad and strong, but it's also dependent on a war outcome that is far from certain. Let's look at non-US stocks. So far this year, international markets have outpaced the S&P 500. Emerging markets are up almost 15%. Global stocks outside the US are up about 9%, and the S&P 500 is trailing with gains just above 5%. And most of it has come from 2 countries, South Korea and Taiwan. And what's driving this is the AI chips. And energy exporters like Canada, Norway, and Brazil have also been doing well. On the other side, energy importers are under real pressure. Germany has seen its GDP forecast cut. The UK is now bracing for inflation above 5%, and India is dealing with LPG shortages. Countries like Bangladesh, Pakistan, and Vietnam are also being hit hard. All of that shows just how uneven global markets are right now. This chart shows the performance of international versus US equities. We can see a clear split between the 2 markets. The big picture here is that international markets have taken the lead in 2026, with emerging markets and select countries driving strong gains, while US stocks, especially the S&P 500, are lagging. AI-heavy markets like South Korea and Taiwan are surging, energy exporters are doing well, and energy importing regions are feeling the most pressure. Lastly, let's talk about the war in Iran. A 2-week ceasefire between the US and Iran took place on April 8th, but the Strait of Hormuz only opened briefly before closing again. After the Islamabad talks failed, the US imposed a naval blockade on Iranian ports on April 13th. And then on April 21st, President Trump extended the ceasefire indefinitely with the US naval blockade still in place. Pakistan brokered talks are ongoing, but there's still a lot of uncertainty about where this goes. Now, in terms of the bigger picture, even if the war ends, the IEA calls this the largest supply disruption in the history of the global oil market. And we're already seeing supply chains reset and rerouted. So even with a permanent ceasefire, the longer-term disruption to global energy markets won't be easily undone. This chart shows the daily number of ships moving through the Strait of Hormuz. In the days leading up to the war, we were seeing roughly 90 to 115 vessels transiting the strait every day. That includes crude tankers, product tankers, LNG carriers, and container ships. Once the war began on February 28th, that traffic essentially collapsed to near zero. After the April 8th ceasefire, the strait reopened, but that didn't last. On April 18th, when Iran closed the strait once more, traffic dropped right back to near zero. So the takeaway here is pretty clear: the Strait of Hormuz is effectively closed. Until that changes, energy prices are likely to remain under sustained pressure. And higher energy prices don't stop there. They flow through to nearly everything else, from food and transportation to manufactured goods. It's all connected. This chart shows Brent crude, the global oil benchmark, from early February through the end of April. Before the war, oil was steady around $72 a barrel. Once the war began on February 28th, prices rose, topping $120 by late March. Then in April, prices dipped briefly on the ceasefire, but they bounced back when talks fell apart. Then they dropped again when the strait was briefly reopened, and then jumped right back once it closed again. We ended April around $114 a barrel. That's the highest it has been since mid-2022, and up roughly 90% from a year ago. This is one of the most important charts because it shows why you can't simply reroute oil around the Strait of Hormuz. Before the war, about 20 million barrels a day flowed through the strait. That's roughly 20% of the global seaborne oil trade. The alternative pipelines you see on the right add up to at most 5 million barrels a day. So even if every bypass runs flat out, there's still a massive shortfall. That's why the IEA calls this the largest oil supply disruption ever, and why there's no quick fix. So we'll leave it there for this month. We all hope, God willing, that this war comes to a peaceful resolution soon. Thank you for taking the time to listen. We'll see you next month to update you on future developments.